All right, so let's dive into something pretty incredible, actually.
Yeah.
Imagine this, right?
Mm-hmm.
You invest, let's say $25,000 back in 2005.
Okay.
And then, like 20 years later, poof, just balloons.
Wow.
To almost $400,000.
That's pretty impressive.
1,400% return.
What?
Yeah.
No way.
No, this isn't some,
Yeah.
get rich quick scheme or anything like that.
Right.
We're talking about the Invesco QQQ Trust.
Interesting.
And we're gonna unpack that.
Okay.
And see what makes it tick.
So the Invesco QQQ Trust.
Yeah.
It's not like some super obscure high risk gamble or anything.
Right.
It's an ETF. Mm-hmm. It's essentially a basket of stocks.
Okay.
That mirrors the Nasdaq 100.
A Nasdaq 100. Okay.
Yeah.
So it's like
you can think of it as like a one-stop shop.
Okay.
For investing in the giants.
Okay.
Of the tech world.
Yeah.
The movers and shakers.
Right.
Driving innovation and all that.
So instead of picking like individual stocks,
right,
you're getting like a slice of the whole.
Exactly.
Nasdaq 100 pie.
A whole pie.
But
yeah.
Here's the thing that really caught my eye.
Mm-hmm.
Why has it like blown the S&P 500 out of the water?
The
S&P 500 had a decent run, over that same period.
Mm-hmm.
Around 700% return.
Pretty good.
Which is not bad.
Not bad at all.
But the QQQ is on another level.
Well, that comes down to the power of growth stocks.
Okay.
The Nasdaq 100 is it's heavily weighted towards companies that are expected to,
grow,
yeah. Yeah. And grow big.
Grow big, right.
These companies often they'll reinvest their profits back into, research and development, expansion and all that.
So they're just fueling
that potential for explosive returns, right?
Right.
We're talking about companies that are constantly, innovating, disrupting industries, capturing market share.
Mm-hmm.
And that's reflected in their stock performance.
I'm sure some people listening are thinking, like, hold on a second, though.
Yeah.
Those growth stocks,
yeah,
they must be, like, ridiculously expensive now, right?
Yeah.
Yeah, and yes.
Yeah.
Valuations can get pretty high.
Yeah.
But here's where it gets really interesting.
Okay.
The Nasdaq 100.
Yeah.
It isn't like a
it's not
static entity.
Oh, right.
It's constantly
evolving,
adapting.
It's not just sitting there collecting dust.
Yeah. In fact,
actually,
just last month, it underwent its annual
reconstruction.
Yeah, like a tune-up.
Yeah.
For your car.
Yeah.
Companies that haven't been performing as well. Mm-hmm. Or no longer fit the criteria.
Right.
They get swapped out for fresh, exciting companies.
Right.
With potentially massive growth potential ahead of them.
Yeah.
For example.
Yeah.
You had companies like Illumina.
Okay.
Supermicrocomputer.
Mm-hmm.
And Moderna.
Okay.
And they were replaced by Palantir Technologies.
Mm-hmm.
MicroStrategy.
Okay.
And Axon Enterprise.
So it's almost like like a
what?
A self-cleaning oven.
A self-cleaning oven.
Out with the stale leftovers.
Right.
And in with a fresh batch
again.
Potential winners.
Winners, exactly.
That's pretty sweet.
Yeah, it's pretty neat.
Yeah.
And that's what keeps the Invesco QQQ Trust at the forefront of the market.
Yeah.
Giving investors access to the companies that are, poised to shape the future and all that.
Right.
It's not just about past performance.
Yeah.
It's about, staying ahead of the curve, recognizing where the puck is going, so to speak.
But let's be realistic here for a sec.
Yeah.
Investing in the stock market.
Yeah.
It can feel like riding a roller coaster.
It can.
How can investors like ride this growth stock wave without getting whiplash?
Right.
Everyone wants to maximize returns, of course.
Of course, yeah.
But managing risk is equally important, wouldn't you say?
Absolutely, yeah. And that's where the concept of,
Yeah.
Dollar cost averaging comes in. Dollar cost averaging, okay.
Instead of trying to, time the market perfectly, which is about as successful as trying to, catch lightning in a bottle.
Right.
Dollar cost averaging involves investing a fixed amount of money at regular intervals.
Okay.
Regardless of, market fluctuations.
So let's say I decide to put $500 into the Invesco QQQ Trust every month.
All right.
No matter what, what the market's doing.
Yeah.
That mean I'm...
So you're like buying more shares when the price is low, fewer shares when the price is high.
Exactly. Well, when the market dips, your $500, buys you more shares.
Okay.
At a discount.
At a discount, right.
And then when the market rises, you benefit from the overall upward trend.
Even though you're buying, fewer shares.
Right.
At a higher price.
Right.
So it's a strategy that smooths out the ride.
Okay.
And potentially maximizes your returns over the long term.
It sounds like a much more manageable and less stressful approach to investing.
It is.
Especially for those of us who aren't,
right.
day traders.
It removes that, emotional roller coaster of trying to time the market.
Right.
And encourages you to kind of take a more disciplined, long-term investment strategy.
Now, this whole deep dive is based on an article from the Motley Fool.
The Motley Fool, yeah.
Pretty well-known source of investment advice.
Yeah.
They're big proponents of long-term investing.
Yeah.
Do they actually recommend any of the companies that are currently in the Nasdaq 100?
Well, as a matter of fact, they do.
Specifically, any of those recent additions?
They've highlighted Axon Enterprise.
Okay.
And Palantir Technologies.
As companies they find particularly promising.
Interesting.
Yeah. So that suggests they, see potential in some of the newer companies. Joining the index.
It seems so, yeah.
Yeah.
And remember.
Yeah.
The Motley Fool's philosophy aligns very well with, our discussion about dollar cost averaging.
Yeah.
And long-term investing.
Right.
They believe in, researching companies.
Right.
Understanding their business models.
Right.
And then holding on to those investments for the long haul.
For the long haul. Yeah.
Allowing them to, ride out.
Right out, yeah.
Market fluctuations and all that.
Yeah.
And potentially reap significant rewards.
So it's it's not about chasing quick profits.
Right.
It's about identifying companies with solid fundamentals.
Solid fundamentals,
Strong growth trajectory.
Exactly. It's about understanding what you're investing in.
Yeah.
And why.
This deep dive has been really insightful so far.
Okay, good.
You've given us a lot to think about when it comes to, power of growth stocks, the dynamics of the Nasdaq 100, strategies like dollar cost averaging.
Yeah.
But what about the risks?
The risks.
Like what happens when interest rates rise or the economy slows down?
Yeah.
Are growth stocks as resilient as other types of investments?
That's a crucial question.
Yep.
And it's important to remember that, no investment is without risk.
Right.
Growth stocks, by their very nature, are often considered riskier than more established, value-oriented companies. They tend to be, more volatile and susceptible to market fluctuations when interest rates rise.
Yeah.
It can make it more expensive
right.
for growth companies to borrow money.
Right.
Which can potentially impact their expansion plans and profitability.
So it's not just a smooth upward trajectory.
Not always, no.
Yeah.
There are bumps.
There are bumps along the way.
And during economic downturns, growth stocks often experience more significant declines
right.
than other sectors. This is because, investors tend to flock to. Yeah. Safer havens like bonds or defensive stocks when uncertainty looms.
That makes sense, yeah.
Yeah.
But what about the specific risks associated with Axon and Palantir?
Yeah.
The companies the Motley Fool recommends. Are there any red flags?
Red flags, yeah.
Investors should be aware of.
That's an excellent question.
Yeah.
While while the Motley Fool sees potential in these companies, it's essential to approach any investment with a healthy dose of, skepticism.
Skepticism, yeah.
Let's take Axon Enterprise, for example.
Okay.
They're a leading provider of tasers and body cameras for law enforcement.
Okay.
Their growth has been, pretty impressive. But they operate in a, politically charged environment, and their reliance on government contracts exposes them to potential regulatory and budgetary risks.
So there's a certain level of uncertainty that comes with investing in companies operating in such sensitive sectors.
Sensitive sectors, exactly. And with Palantir Technologies, data analytics and software company, their business model is heavily reliant on government contracts, particularly with intelligence and defense agencies. This can be, a lucrative market. But it also comes with ethical considerations and potential for, controversy.
Seems like due diligence is paramount.
Yeah.
It's not enough to just follow recommendations.
Exactly.
Investors need to really understand
the companies,
their
operations, and the potential risks.
The potential risks involved, absolutely.
This is getting really interesting.
Good.
I'm starting to see that there's a lot more to consider. Than just past performance and potential return.
Exactly. It's a complex landscape, and there's no one-size-fits-all answer.
Speaking of a complex landscape, let's talk a little bit more about how the Nasdaq 100 is constructed.
Okay.
You mentioned the
annual reconstruction.
Annual reconstruction,
But how does that actually work?
How does that work?
How are companies selected for inclusion or removal?
That's where it gets really fascinating. Okay. The Nasdaq 100, it isn't just a random collection of the 100 largest companies.
Right.
On the Nasdaq Stock Exchange.
Right.
There are specific criteria.
Right.
That companies must meet to be eligible for inclusion.
Right.
And these criteria, they're reviewed and adjusted, regularly.
So what are some of these key criteria?
Key criteria.
Is it just about market capitalization?
Well, market capitalization is certainly a significant factor to be eligible.
Yeah.
A company must have a minimum market capitalization, which is essentially the total value of all of its outstanding shares. But it goes beyond that.
So what else is considered?
Well, liquidity is another crucial factor. A company's stock needs to be traded frequently, and in sufficient volume, to ensure that that investors can buy and sell shares easily, without significantly impacting the price.
Right.
This is important for the overall health and stability of the ETF.
Yeah, you wouldn't want a situation where it's hard to buy or sell shares of the ETF because one of its underlying holdings is illiquid. And then there are financial criteria. So companies must meet certain standards related to, their earnings. Revenue. Financial health.
To even be considered.
Your key call.
To even be considered.
For
inclusion.
For inclusion, yeah.
This helps ensure that the Nasdaq 100 comprises companies with a track record of, financial stability and growth potential.
So it's not just about being a big company.
Right.
It's about demonstrating financial strength.
Exactly.
Sustainable business
model.
Yeah.
And there's another intriguing aspect to the selection process.
Yeah.
The Nasdaq 100 aims to maintain a balanced representation across, various industries and sectors.
Right.
They don't want the index to be overly concentrated in just a few sectors.
Okay.
Like technology, for instance.
That makes sense, yeah.
Yeah.
Diversification is
a
key principle of investing.
Of investing.
Yeah. And it seems like the Nasdaq 100 incorporates that
it does,
principle into its very structure.
Yeah. It's about mitigating risk.
Right.
By, spreading your investments across different industries. So if one sector experiences a downturn, the others can potentially cushion the impact.
Okay, so we've covered a lot of ground here.
Yeah, we have.
We've talked about the incredible performance of the Invesco QQQ Trust.
Yeah.
The power of growth stocks.
Right.
The concept of dollar cost averaging.
Yeah.
And the dynamics of the Nasdaq 100.
Yeah.
But before we wrap up this part of our deep dive, I want to circle back to something.
Okay.
You mentioned earlier the ethical considerations.
Oh, yes.
Associated with investing in companies like Palantir Technologies.
Yeah.
This raises an important question.
It does.
For all investors, really.
Right.
Like, how do you balance the pursuit of financial returns with your own, ethical values and principles?
That's a truly thought-provoking question.
Yeah.
And it's a fascinating dilemma, isn't it?
Yeah, it really is.
How do we balance that pursuit of profit with our own sense of, right and wrong?
And it's something I think every investor needs to think about.
Yeah.
Carefully.
Absolutely.
Our investments are like a reflection of our values, right?
Exactly.
If we're putting money into companies that are doing things we disagree with, are we indirectly supporting those actions?
Precisely. And it's not always easy, to find that perfect alignment between financial goals and ethical considerations. Sometimes there are trade-offs to be made.
Right.
But I think it's crucial to at least be aware of the ethical implications of our investments and to try to make choices that we can feel good about.
So what are some practical steps investors can take to ensure their investments align with their ethical values?
Well, the first step is to define what those values are.
Right.
What issues are most important to you?
Yeah.
Environmental sustainability, social justice, corporate governance.
Right.
Once you have a clear understanding of your priorities, you can start researching companies and investment funds that align with those values.
Right. So it's about doing your homework.
Doing your homework. Yep.
Digging a little deeper.
Digging deeper. And not just blindly following recommendations or chasing returns.
Exactly. There are many resources available to help investors make informed decisions. Yeah. You can look into ESG ratings. Which evaluate companies based on their environmental, social, and governance performance.
Right.
You can also explore,
impact investing.
Impact investing,
which focuses on investments that generate positive, social or environmental impact, alongside financial returns.
So there are actually like investment options out there that specifically target companies that are trying to make a positive difference.
Positive difference,
in the world.
Absolutely, and this area of investing is growing rapidly,
right?
As more and more people are looking to, align their money with their values. It's not just about maximizing profits anymore. It's about using your investments as a force for good.
Okay, let's shift gears a bit and talk about alternative investment strategies.
Okay.
We've focused heavily on growth stocks. And the QQQ.
The QQQ, right?
But are there like other approaches investors might want to consider, especially if they're like concerned about the the potential risks associated with growth-heavy portfolio's?
That's a great question. And the answer, of course, is yes.
Okay.
There are many different, investment philosophies and strategies, each with its own set of risks and potential rewards. It really depends on your individual goals, risk tolerance, and time horizon.
So what are some of these alternative approaches?
Well, one popular alternative is value investing.
Value investing, okay.
This strategy involves identifying companies that are, undervalued by the market.
Right.
Yeah. These are often companies that are out of favor for some reason.
Right.
Maybe they've had some, temporary setbacks, or their industry is going through a rough patch. But value investors believe that these companies have strong underlying fundamentals and that their stock price will, eventually rebound, leading to, significant gains.
So it's like finding hidden gems.
Yeah, like finding hidden gems
that the market has. Like overlooked.
Exactly. Yeah. And value investing has historically been a very successul strategy.
Okay.
It's been championed by, legendary investors like Warren Buffett, who's built his fortune by identifying and acquiring undervalued companies.
That's
pretty
impressive company to be in. But value investing sounds like it requires a lot of patience and a long-term outlook.
It does. Value investors aren't looking for, quick profits.
Quick profits, right.
They're willing to hold on to their investments for years, even decades, waiting for the market to recognize the true value of the companies they've invested in.
So that's definitely a different mindset than, the growth at all costs mentality we often hear about in like the tech world.
The tech world.
What other
alternatives are out there?
Another popular approach is dividend investing.
Dividend investing, okay.
This strategy focuses on investing in companies that pay dividends, which are essentially, regular cash payments, to shareholders. Okay. These dividends can provide a steady stream of income, which can be, particularly appealing to investors who are, retired or looking for a more conservative approach.
So instead of relying solely on capital appreciation, dividend investors are also getting a regular payout from their investments. That sounds like a good way to supplement your income or reinvest those dividends to further grow your portfolio.
And there are many different types of dividend-paying companies. Some are, mature, well-established companies that have a long history of paying dividends, while others are, younger.
Faster-growing companies that are starting to, distribute profits to shareholders.
It seems like there's a lot of variety within this.
There is,
dividend investing world as well.
Yeah.
Are there any other investment strategies?
Of course.
We should be aware of?
We could, we could spend hours talking about all the different investment approaches.
Right.
But to give you another example, there's index fund investing.
Index fund investing.
Which is a very popular and often recommended strategy, particularly for, beginner investors. Index funds are essentially passively managed funds that track a specific market index.
Okay.
Like the S&P 500 or the
fund. Yeah. Isn't the Invesco QQQ Trust the one we've been talking about?
Yeah.
An index fund.
That's right. It's an index fund.
So in a way, we've been talking about index fund investing this whole time.
Yeah.
Okay, so what's the main advantage of like investing in index funds?
Well, index funds are they're designed to match the performance of the underlying index rather than trying to outperform it.
Right.
This means they typically have lower fees than actively managed funds, and they often deliver solid returns over the long term.
That sounds like a pretty sensible approach, especially for investors who don't want to, spend all their time researching individual stocks or trying to beat the index fund investing is all about simplicity, diversification, and long-term growth.
Okay.
It's a strategy that can be used to build a well-rounded portfolio and achieve your financial goals without having to become a Wall Street.
Wall Street. Okay, so we've talked about growth stocks.
Growth stocks.
Value investing.
Dividend investing. Index fund investing.
Yeah.
Are there any other major investment approaches where?
Well, we could we could delve into more specialized strategies like hedge funds, private equity, or real estate investing.
Yeah.
But those are often more complex and require a higher level of sophistication and capital.
Okay. So maybe we'll save those for a future deep dive.
Yeah.
For now, let's focus on the strategies that are accessible to most investors.
Most investors, right.
And speaking of accessibility, I'm curious about your thoughts on dollar cost averaging.
Dollar cost averaging, yeah.
We touched on this earlier.
We did.
But I'd love to hear more about how it works in practice.
Yeah, I'm happy to elaborate. Dollar cost averaging is a fantastic strategy for both beginner and experienced investors. It's all about removing the emotion from investing and taking a disciplined approach instead of trying to time the market, which is incredibly difficult. It's not impossible. You simply invest a fixed amount of money at regular intervals, regardless of what the market is doing.
So it's like setting up like an automatic investment plan where a certain amount of money is deducted from your bank account and invested in the
QQQ every month, no matter whether the market's up, down, or sideways. Exactly. It takes the guesswork out of investing, and it helps you stay invested consistently. Which is crucial for long-term success.
Can you give us like a hypothetical example of how dollar cost averaging might work?
Of course.
In practice.
Let's say you decide to invest $500 every month in the Invesco QQQ Trust. In some months, the market might be, down. So your $500 will buy you more
shares.
In other months, the market might be up. And your $500 will buy you
fewer shares. Right.
The beauty of dollar cost averaging is that you're not, trying to predict the market's movements. You're simply, taking advantage of the natural fluctuations to gradually build up your investment over time.
So in the long run, you're averaging out
your purchase price.
And potentially reducing your
overall risk.
Exactly.
And by consistently investing over time, you're also benefiting from the power of compounding.
Compounding, yeah.
Where your returns generate further returns, creating a snowball effect that can lead to, significant wealth accumulation over...
That's pretty incredible.
It is.
It's like planting a seed and watching it, grow into a mighty oak tree.
Grow into a mighty oak tree.
Over time.
Over time.
But let's be realistic. Dollar cost averaging isn't a magic bullet.
It's not a magic bullet.
Is it?
No.
There are still risks involved in investing, even if you're taking a a disciplined long-term approach.
You're absolutely right.
Yeah.
No investment strategy can eliminate risk entirely. Yeah.
The market is inherently unpredictable, and there will always be periods of volatility and uncertainty,
right?
Yeah.
So what are some of the potential drawbacks or risks associated with dollar cost averaging?
Okay.
I mean, it sounds great in theory.
Yeah.
But are there any situations where it might not be the best approach?
Well, one potential drawback is that it can take time to see significant returns, especially if you're investing in a volatile market, in a rapidly rising market. Dollar cost averaging might actually underperform compared to investing a lump sum up front. This is because,
you're spreading out your purchases, so you might miss out on some of the initial...
So there's the potential opportunity cost.
Opportunity cost involved.
Yeah.
But isn't that, isn't that outweighed by the reduced risk and the psychological benefits of not having to, worry about timing the market perfectly?
That's a valid point.
Yeah.
For many investors. The peace of mind.
The peace of mind.
And the reduced risk. Associated with dollar cost averaging. Outweigh the potential.
The potential opportunity cost. It's about finding a strategy that aligns with your risk tolerance. And investment.
Okay, so dollar cost averaging isn't.
But
perfect. No. But it seems like a solid strategy. For long-term investors who want to, build a diversified portfolio and minimize the stress. Of trying to climb the market.
Exactly.
Yeah.
And remember, no matter what investment strategy you choose, it's essential to do your research, understand the risks involved. And invest only what you can, afford to. Yeah.
That's great advice.
Yeah.
We've covered a lot of ground today.
We have.
From the power of stocks
yeah.
to the intricacies of dollar cost
averaging.
Yeah. But we're not done yet.
It's not done yet.
In our final segment, we'll explore some of the biggest trends.
Okay.
Shaping the investment landscape.
All right.
And discuss what the future might hold.
Okay.
For the QQQ.
Yeah.
The companies that make up this dynamic index fund.
Okay.
Stay tuned.
Welcome back to our deep dive into the world of the Invesco QQQ Trust.
Yeah.
We've explored its impressive track record, the dynamics of growth stocks.
Right.
And various investment strategies. Now let's turn our attention to the future.
To the future.
What are some of the big trends shaping the investment landscape?
Yeah.
And what do they mean for the QQQ and the companies that comprise it? That's a fantastic question.
Yeah.
The investment landscape is constantly evolving, driven by technological advancements, geopolitical shifts, and changing consumer behavior.
Right.
One of the most significant trends we're seeing is the rise of artificial intelligence.
Artificial intelligence.
Or AI.
Right.
AI is already transforming industries from healthcare to finance, and its impact is only going to grow in the coming years.
So how does AI factor into the QQQ specifically?
Yeah.
Are the companies in this index fund well positioned to capitalize on?
Absolutely. Many of the companies in the Nasdaq 100 are at the forefront of AI innovation. Right. They're developing the the algorithms, the hardware, and the software that are driving this technological revolution. Think of companies like NVIDIA, which makes the graphics processing units that power AI applications. Right. Or Microsoft, which is investing heavily in AI research and development.
So it seems like AI is more than just a buzzword.
Yeah.
It's like a fundamental shift.
Yeah.
That's gonna
it's a fundamental shift.
Yeah, like reshape
the way we live and
work. Yeah.
Work. Yeah. And it's exciting to see that the that the QQQ is providing investors with exposure to this this transformative trend.
Yeah.
What other trends are on your
well, another trend that's closely intertwined with AI is the
growth of cloud computing.
Cloud computing.
Yeah. Cloud computing is essentially the delivery of computing services, servers, storage, databases, networking, software, analytics, and intelligence over the internet.
Okay.
The cloud,
right?
Companies like Amazon with its Amazon Web Services platform, AWS, and Microsoft with its Azure platform, are leading the way in providing cloud infrastructure and services to businesses of all sizes.
So instead of companies having to build and maintain their own expensive data centers,
they
can essentially
rent
computing power
from these
cloud
providers.
Exactly.
It's a much more efficient and cost effective way for companies to access the computing resources they need. And as more and more businesses, migrate to the cloud, the companies providing these services are poised for continued growth.
It's fascinating to see how these technological advancements are creating
new opportunities
and disrupting
traditional industries.
It makes you wonder what the world will look like in 10 or 20 years.
No, it's pretty crazy.
What other trends are you?
Okay, well, another significant trend is the increasing focus on sustainability and environmental, social, and governance factors. Investors are becoming more aware of the impact their investments have on the world.
And they're demanding that companies operate in a more responsible and sustainable manner.
So it's not just about profits anymore. It's
not just about profits anymore.
Like purpose as well.
Exactly.
Right.
Investors are looking for companies that are not only financially sound, but also aligned with their values and committed to making a positive impact on society and the environment.
That's a really encouraging trend.
Yeah, it is. It
suggests that we're moving towards a more conscious and responsible form of
capitalism.
Capitalism. How does this ESG trend play out in the context of the QQQ? Are the companies in this index fund embracing sustainability? It's a mixed bag. Some companies in the Nasdaq 100 are leading the way in sustainability initiatives. They're reducing their carbon footprint, investing in renewable energy, and promoting diversity and
inclusion. Others are lagging behind and facing pressure from investors to improve their ESG performance.
So there's a range of performance.
A range of performance, yeah.
When it comes to ESG, just like there is with
financial performance,
it sounds like investors need to do their research and understand how the companies they're investing in are, addressing these
important issues. Yeah,
important issues.
Absolutely.
And this is where ESG ratings and research.
Our research can be invaluable.
Yeah,
there are organizations that evaluate companies based on their ESG performance, providing investors with insights. To make more informed decisions.
Yeah.
It seems like we've only scratched the surface of these trends.
Yeah.
There's so much happening in the world of technology, sustainability, and finance. It's a lot to keep up with.
It is.
This deep dive has been incredibly insightful.
Okay, good.
You've given us a lot to think about.
Okay.
From the mechanics of the QQQ to the broader trends.
Yeah.
Shaping the future of investing.
Yeah.
Any final thoughts you'd like to?
Yeah, my final thought would be this: don't be afraid to learn and
explore.
The world of investing can seem daunting at times, but it's also incredibly rewarding. The more you understand about different investment strategies, the companies you're investing in, and the trends shaping the market, the better equipped you'll be to make informed decisions. And achieve your financial
goals. Yeah. I think that's excellent advice.
Yeah.
Knowledge is power, especially when it comes to investment.
Completely.
We've given you a shortcut to understanding the Invesco QQQ Trust.
Yeah.
But the real learning comes from your own exploration and
research.
Yeah. So go out there, ask questions. Dig deeper. And make your own informed decisions. And remember, the most rewarding investments are often the ones that align with your values. And contribute to a better future. Until our next deep dive. Happy investing.
Happy investing.